Yeah, okay. So, yeah, welcome everyone. So, in this session, we'll be actually discussing about the basics of creating a business plan. So, this is one of the most sought after kind of topic for startup founders. So, we'll be helping to understand how to create a basic business plan. And the reason why which I'm telling, keep on telling basic business plan is kind of I'm not sure whether the business plan, what I'm telling, may be helpful to you, but in fact, the idea is similar. The idea is same for every business, but the model in which you will have to create your own business plan will actually differ, depending on your business, what sort of segment you are in, and a lot of other things. Okay. So yeah, so I'm not sure how many of you have attended my first session, which happened to be like a month ago. So in that, we actually discussed on, we gave an overview of fundraising process and how to create a business plan or how much funds to be asked to an investor. So that is a burning question here also. We'll be actually discussing on how much funds we'll be raising from a investor. So we'll first of all we'll address the question using a PPT, and I'll just explain the theoretical part, and then we'll move on to an Excel. And having said that, we'll be moving on to an Excel. Please note that this won't be uh, an Excel session. It won't be. I won't be helping you with the shortcuts or anything. I'll just uh, show you how to create a business plan in Excel. How to kind of forecast how much cash flow you need, how much funds you will be required to be raised from an investor and all. This would be the key takeaways from this session. Yeah. Yeah. So I think I'll just move on to the theory part. Yeah, okay. So, why to raise funds and how much funds to raise? So this was the slide what we used in the first session. And guys, like for those who are joining for the first time, if you have any queries or anything in between, you can put in the chat box. We'll respond to that in between the session. And you cannot unmute yourself, so we'll be actually giving a session where there will be a Q&A session wherein actually you can put your queries. Okay. Yeah. Okay. So yes. So we are actually will start. So basically, a company, any company or a startup or anything like requires two sort of cash flow. So one is for the operational cash flow for meeting the operational expenditure and stuff, and then one is for asset building or one-time setup cost. Okay. So first of all, we'll go for the operational cash flow. So if you are a startup and you require a heavy marketing budget, or you need to employ a lot of people before you become revenue generating, then you will be requiring cash to meet these marketing expenses, the salaries, rent, and all those overheads. So this is what is called the operational cash flow. And why I have mentioned deficit in operational cash flow is because it's just because it's excess of expense over revenue. For example, you have started generating revenue, but your revenue is not enough to meet the expense. For example, you are generating a revenue of 1 lakh per month, but your overheads are say 5 lakhs per month. Then you need to be funded by 4 lakhs per month. That's the common logic. Okay. And the second item for which we raise fund is for asset building or one-time setup. When I say asset building or one-time setup, it can be for setting up an office space, it can be for creating an intellectual property, or it can be for purchasing furnitures or whatever. So that is the one-time setup cost. So basically, every company, every startup, every company, every SME, everybody requires fund for these two items only, predominantly for these two items only. And if you have some loan or something, then you will have to have a fund for repayment of loan, but that does not comes under this startup thing. So I'm just intentionally skipping that part of the cash flow. So we'll be actually discussing about operational cash flow and asset building or one-time cash flow. So the funds to be raised is nothing but the operational cash flow deficit plus one-time cost. Okay. So this is how we'll be ascertaining how much and what funds to raise, and what is the reason for raising funds. So usually what startups do is this might be repetition for people who have been part of my first session, but I see a lot of new faces also, so I'll just explain. So one mistake what startup usually does is kind of they determine a fund, like kind of they keep a ballpark figure, say 2 crore or something, and then they back calculate like how are we going to spend this 2 crore. So that is not the ideal way to approach a fundraising deal. It should be the other way around. Like you will have to actually ascertain how your cash flow is going to be for the, say suppose you are planning a fundraise for next 18 months or 24 months, or say maybe for 10 months at least. So in the next 10 months, what is your revenues going to be? What are your expenses going to be? What are your setup costs going to be? And whenever I say setup cost, it needn't be incurred on the first month itself. For example, it can be incurred in the fifth month, wherein you are having a more hiring happening in the fifth month, and you need say more laptops during that time. So it can be that way also. So, like when I say setup cost, don't expect it to be in the starting of the period. So, coming back, like if you are estimating it for 10 months period, so we estimate the cash, how much gap we are going to uh, have kind of after 10 months, and then like kind of will I'll come to the Excel part, then it will be more clear to you. So we'll be estimating like how much is the monthly revenue, how much is the monthly expense, how much expenses are exceeding the monthly revenue. Then we will actually accumulate this amount plus the one-time setup cost we will add. And this is the fund that we should ask the investor. It is not like, okay, we'll raise 2 crore. Okay, we'll raise 2 crore at 20 crore valuation. Then, okay, where are we going to put this 2 crore? Okay, 1 crore we will put in marketing. 30 lakhs we will put in salary. 50 lakhs we will put for this one, setting up office. Then what about the balance 20 lakhs? Okay, we'll put it as working capital. So this is what usually I see many startups do. They put the balancing figure as working capital. So see, there is nothing sort of scientific explanation to this, but you cannot put like kind of as a balancing figure as working capital. Suppose you do a kind of business plan and you ascertain that you require 1.56 crores for next 12 months. Maybe you can add a buffer and ask the investor for 1.75 crore, which the investor would also understand, which you can also justify. Like things may not go as per plan. So you may be requiring a little bit of buffer amount so that you don't end up kind of falling short of amount. Okay. So I hope this theoretical part is clear to you. Now we'll just move on to the Excel. If anybody have any question, you can just put it in the text box, in the chat box. So I'll just move to the Excel part. Okay, so I hope everybody can see the screen. Should I zoom in a bit more? I hope it's visible. Fine. Can you please type it's fine in the chat box if it's visible? Yeah, okay. Okay. One more zoom. Okay. Yeah. Now it's fine, right, Param? Okay. So yes, so this is the basic business plan which I have created, and if time permits, we'll try to create one on our own. And like I've told in the beginning, this is not going to be an Excel session. I'll be using shortcuts and formulas, which you can actually Google and find it out. Okay. So suppose this is the 12-month projection for a startup. Okay. So we are not expecting any revenue in the first 3 months. In the fourth month, we expect that our product would be live and say some number of customers would be buying it, and we expect a revenue of 50,000. Then going on to month 5, it becomes 1 lakh. Then it becomes 1.5 lakh, 2.5 lakh, 5 lakh, 7.5 lakh, 10 lakh. So there is going to be a growth that is going to happen. Okay. So eventually it becomes 20 lakh at the end of 12th month. Okay. So this is what happens there. Okay. And then we are estimating the expenses. So like I told, this company is not generating any revenue in the first 3 months, but definitely they will be incurring some expenses in the first 3 months because they need to pay salary, they need to pay rent, they need to meet some other expenses. This other expenses can be refreshment or whatever it is. It is just other expense, like whatever comes under. So this is just an example thing, not a very critical thing or anything. Okay. So, so suppose this company is having 2.5 lakhs worth salary month 1, 50,000 worth rent in month 1, and other expenses amounts to 1 lakh. So if you see the projection, I've just kept it in such a manner that the salary expense increases for a while because we hire people occasionally. In this company's case, we are hiring from month 1, month 2, and month 3. Then it is kind of stable. Then at month 10, we are hiring somebody else also. If you can see, it moves to 6 lakhs now. Okay. But the rent is almost same throughout the year. It is like that throughout the year. Only after a year, there will be a 5% or 10% hike, depending on the place where you are in. In Kerala, Bangalore, and all, I see a kind of 5% hike usually. And the other expense also remains stable. So we have an operational expense of, say, 4 lakhs in month 1, 5 lakh in month 2, 6.5 lakh in month 3. Then goes on like whatever it is given there. And this company is going to be kind of heavily depending on marketing to generate revenues. Okay. So in the first month, they need to spend, say, 10 lakh on marketing. So why it is high in the first month is because I have assumed that they have some launch or something. They're launching a product or something. So they are putting in some money in the first month. Then they are spending kind of 5 lakh and 5 lakh in the first 2 months to get the initial traction. Then kind of it regularizes, and then they are trying to kind of maintain a 3 lakh cash flow every month for the marketing expenses. Hope this is clear now. And then we have in month 1, like we need like kind of say this is heavily tech intensive company, and they need high configuration laptops and computers. For that, they are spending 25 lakh in month 1. Then they are getting some software licenses for 3 lakh. And then there are other capex or one-time costs, which can be the furnishing of the office. They need to buy furniture. Okay. They need to do the interiors. They need to whatever, like kind of buy a coffee machine or whatever one-time expenses are coming, buy an air conditioner. Those sort of costs comes to 10 lakh. So in the month 1, we are spending 38 lakh. So like I told, this capital expenses won't be kind of happening every month. It will be happening occasionally only. So here, firstly, they are putting in 38 lakh rupees. Okay. Then in the second month, they are not buying anything. Third month also, they are not buying anything. In the fourth month, they seem like they need more computers or whatever reason. They are investing another 10 lakh into the asset building part. So in the third month, in the fourth month, they invest 10 lakh. Then onwards, there is no other investment happening. So now the question is kind of how much fund this company is going to raise for the next 12 months is the question. Okay. So if you look at the net cash flow, so net cash flow is a monthly kind of thing. So it is, if you see, it is D4 minus D6 minus D11 minus D14. So D4 is revenue minus the operational. So revenue is the cash flow that the company generates by its own kind of sale or anything. And it has to meet 4 lakhs of operational expense. It has to meet 10 lakhs of marketing expense and 38 lakhs of capital expense also. So that is how it is D4 minus D6 minus D11 minus D14. Hope it is clear. In the second month, the cash flow is minus 10 lakh. Third month, it is minus 11.5 lakh. Fourth month, it is minus 19 lakh. And from the fifth month onwards, like kind of, like I told, the revenue is started increasing. The marketing spend we have reduced. So the cash flow is reducing now. It is minus 8.5 lakh, then minus 8 lakh. And eventually by 10th month, it becomes 50,000 negative. And from 11th month onwards, the company turns cash flow positive. So they are having 4.5 lakhs of positive cash flow in month 11 and 9.5 lakh of positive cash flow in month 12. So now you get a clarity on like how this fundraising is happening now. So usually one mistake what people do is they sum up the total of this thing, and if you can see the sum here in bottom part, it is 1 crore 9 lakh 50,000, and that is the fund people usually ask for, but that is wrong. That is wrong. So that is why I have added this cumulative cash flow also here. So cumulative cash flow is nothing but they need 52 lakhs in month 1. By month 2 to run second month, they need minus 52 lakh plus the minus 10 lakh, 62 lakh. In the third month, it is minus 62 lakh plus minus 11.5 lakh. and eventually they needed by the end of 10th month, they needed 1 crore 23 lakh as cash flow. Then it starts reducing. So now if you raise 1 crore 9 lakh, 9 lakh rupees only, considering the sum total of net cash flow, see, this is the sum total is coming here. If you raise 1 crore 9 lakh only, you will be burned out here. You won't be able to survive month 7. You won't be able to survive month 8. So you have to create a cumulative cash flow and ascertain what is the maximum cash flow, that negative cash flow that you are going to have. And that is the fund that you have to raise, and not the sum total of the whole cash flow. Okay. So here in this case, it happens in the 10th month and it happens to be 1 crore 23 lakh. And then after the cash flow reduces only because we are starting to generate positive cash flow. So if you are raising funds for this company, the fund that this company should be raising for over the next 12 months period is 1 crore 23 lakh. I hope this is clear to everyone. And like I have told, this is just a basic business plan. Please understand that you cannot put revenue figures like this when you are preparing a detailed business plan. This is just an indicative thing. So suppose you are doing a marketplace business or whatever it is, you will be having different sales channels. Or if you are into trading, if you are doing B2C, direct to consumer brands, like in that case also, for example, you will be having separate sales channels. You will be having online sales, wherein you have your own platform and you are selling through your own platform. You will be selling through Amazon, you will be selling through Flipkart, you will be selling through Mindra. Then you will be doing B2B, wherein you are selling to B2B brands, and maybe you will be having stores in malls, wherein that is another sales channel. So it's actually important to understand what all sales channels we are operating in, and then determine the projected revenue. So we'll have to go a bit more detail into this, but this is the basic idea of creating a business plan. And I don't think I can be more detailed because every business is different and every startup is different. So for that, I cannot create a kind of plan for a detailed business plan, but just understand this is the thing. And this revenue, maybe you can break down into online revenue, B2B revenue, whatever it is. Okay. So yeah, so that is all about creating a business plan. So we'll just have a short Q&A part, and then we'll kind of try to continue. If anybody have any question, you can raise your hand or put in the comment box, then we'll unmute you. So is the concept clear to everyone? Like, do I need to explain it once more? If it is clear, if you can type out, it's clear. So Amal has raised his hand.
I'm audible?
Yeah, yes, Amal, you can.
Just wanted to know, should we consider the interest also during
If
that
you
period?
have if you definitely have a cash outflow, if you're paying interest to somebody, then definitely you should be considering the interest amount also. So it is
Okay.
basically, that's what I told. Like, see, in this case, I haven't actually considered interest because it's a kind of very early stage startup which does not have any loan or anything. They are just starting of the business, and they are going to raise equity investment or something. So if you have
Okay.
a loan repayment, not only interest, if you're taking a bank loan and you want to repay the loan amount, like there will be a principal portion also. So you will have to consider the principal repayment also in that case. Okay. So
Hello.
yeah. Hi, Shijin. Yeah.
Sir, actually, I find some companies are reporting their financials in a quarterly time range. Why is that?
See, it depends from company policy to company policy. Like, but while creating a business plan, see, I'm actually discussing about the business plan point of view. If you ask me, it should be, I would suggest it to be on a monthly basis, because how much you can break down and kind of start it from a base level, that's the better. And if you ask me why companies prefer the quarterly, like why some companies follow that, that may be their internal choice. Like and listed companies, I think for them, they have to publish quarterly results is what I believe. I don't, in the case of startups, I don't see any, they don't publish results anyway, like they just file it in the MCA website. But I don't think it's mandatory to go in that manner. But while creating a business plan, I would suggest to go for a monthly kind of thing.
Oh, okay, sir. Okay, sir. I understand. Got it. Thank you.
Yeah. Anybody else have any question? Do I need to explain this concept once more, or it's clear? Okay. Okay, so then I think we'll just summarize the things and we'll wind up the session soon. So yeah, so basically we spoke about the basics of creating a business plan, and like I told earlier, what amount of funds to be raised is a very kind of tough question faced by every startups or company, or be it anyone. Like we don't have clarity on how much funds we should be raising. So in order to address that, we should be actually creating a business plan, and basically fund is required predominantly for two things. One is for the operational cash flow, and other one is for one-time setup cost or purchasing of asset or something. Then I told about like what operational cash flow is. It is kind of like you have to pay your salaries, you have to pay your rent, you have to pay your marketing expense and everything, but you have only very little revenue, or say you don't have any revenue. In that case, you need to pay this amount of. So for that, you will be requiring cash, and definitely for setting up a company, for incorporating a company, for setting up an office space, for paying the deposit, for buying furnitures, for buying computers, you will be requiring funds. So that is the second item. And we'll be actually kind of breaking this down on a monthly basis. We'll create month 1, month 2, month 3, up to whatever month you are raising the fund. See, this all depends on your business and how much months you require funds for. So in the example what I have shown, it's like kind of 12 months, and we'll be breaking down the what revenue will be generating in month 1 to month 12, and what expenses will be. Yeah, I'll just share the Excel sheet. Yeah, so I think it's visible now. Yeah, okay. So we'll be breaking down into month 1, month 2, and then till month 12. Here I created it for a 12-month kind of period. Then we'll be ascertaining what revenue we will be generating each month, what expenses we will be incurring each month, what would be the marketing cost for each month, then what all capital expenses we would be incurring each month. Based on that, we have arrived at the net cash flow, which is nothing but revenue minus operational expense minus marketing expense minus capex. So this is the net cash flow. We'll be computing it for every month. And please note that it's not the sum total for 12 months that you should be asking. It is the maximum of the negative cash flow that you have during this 12 months period that you should be asking. The reason I've told before, see here, if you take the total, it is coming to 1 crore 9 lakh. That is the, if you are raising 1 crore 9 lakh, what happens is we will get stuck in month 6. We won't be able to kind of get over month 7, month 8, or month 9 and month 10. So the amount you should be asking is 1 crore 23 lakh. Maybe you can ask a buffer. The investor would understand it, and your plan may not go as per your plan. There can be a 10%, 20% plus or minus all the time. So maybe putting a 10% buffer, you can ask for close to 1 crore 35 lakhs or 1 crore 40 lakhs from the investor. Okay. So the cumulative cash flow is the template what should be using, and the maximum of the cumulative cash flow is the fund that should be asked. So cumulative cash flow is nothing but the sum total of, so it's like kind of first month it is 52 lakhs only coming. Second month it is 52 lakhs plus 10 lakhs, 62 lakhs. Third month it is 62 lakhs plus 11.5 lakh. And in the 10th month, we understand that we require 1 crore 23 lakh. And in the 11th month, it actually reduces to 1 crore 18 lakh because 11th month onwards, we turn cash flow positive. Okay. So yeah, so I think this is clear to everyone. So we'll just wind up the session. I have a question from Vishal Bansal. I will GST be included in sales and purchase while preparing? See, that is up to you. Again, GST component has a cash flow effect because you will have to pay GST to the government. It's better if you include the GST component also. Like I told, not better. You should be including the GST component also because see, in the initial time period, for example, I put the marketing expenses 10 lakh, but you will have to pay 10 lakh plus GST to the consultant. So it will not be 10 lakh that you will be paying to the consultant. It will be you will be paying 10 lakh plus GST 11 lakh 80,000. So you will have to have a cash flow of 11 lakh 80,000. So you should be including the GST part. Okay. Yeah. Okay. So thank you everyone. Thank you. So sir can raise or include company registration cost in. Yeah, definitely you can include that, but definitely when you're going for a fundraising thing, you should be already having a company which you might have already incurred. So the investor expect you also to put in some money in the initial phase, at least for incorporating a company. But definitely that is also a part of the one-time setup cost. Srijan. Yeah, recording we'll be sharing. Sugna will be sharing it in the WhatsApp group. So Dinesh has put the WhatsApp group link. If you're not part of the WhatsApp group link, you can join the WhatsApp group. We'll be putting the recording link in that group. Okay. We should be setting up a company before fundraising, Srijan. That's kind of a basic requirement. That's a basic requirement. And with an idea, you cannot go and pitch it with an investor. Without having a company, you cannot raise fund. Okay. So thank you, everyone. Thank you for being online this time. Thank you for being interactive. We'll have another session in next couple of weeks' time. Thank you, everyone. Thank you. Bye. Good night.